no one makes money in Coimbatore stocks. So I went to a Madras Stock Exchange broker and told him I want to buy this Coimbatore stock. He said, no, I hail from Coimbatore. I can tell you, you can't make money. I bought it and made good money over the next 5 years.
What did he have to say then?
He became a lifelong friend. Investing is a lonely business. Investing is not arithmetic. It was lonely, completely lonely. Imagine the year 1999 and being negative on TMT.
What are some of the tips that you have for someone who's trying to pick on the temperament but is also actively investing?
Learn to buy an asset class which is done very badly.
If every retail investor could follow only one rule and forget everything else, do you have a rule?
Simple asset allocation.
Hello and welcome back to Paytm Money Masterclass. I am Farzeen and I'm honored to be joined by one of the sharpest investing minds in the country, Mr. Sankaran Naren, ED and CIO of ICICI Prudential AMC. So glad to have you on Paytm Money Masterclass, sir.
My pleasure.
So from the start, before Sankaran Naren, the CIO, there was Sankaran Naren, the first-time investor. What was your first investment like and what did it teach you?
So I went to a Madras Stock Exchange broker and told him I want to buy this Coimbatore stock.
Okay.
And this company was based in Coimbatore. And when I asked him this question, he said, no one makes money in Coimbatore stocks. So I told him, I've studied in financial analysis. I've done all the work. I'm going to buy this stock. And he said, no, why? I hail from Coimbatore. I can tell you, you can't make money. I bought it and made good money over the next 5 years.
What did he have to say then?
He became a lifelong friend.
Oh, really? How wonderful. So is there something that you believed at 25 that you completely disagree with now?
At the age of 25, I thought there was only one asset class in this country, that is equity, equity, and equity. Okay. Whereas today I believe much more in asset allocation than only equity, equity, and equity.
That makes a lot of sense. So you've built a reputation as someone who goes against the crowds, a contrarian investor. Has there ever been a time where you've believed in something but others have disagreed with you?
There were two times. One was in the year 2007 when the markets went just too high. And I was thinking, am I wrong in thinking that the markets are too costly? And I was in my third year of fund management in 2007. So I went through a lot of self-doubt. It took 1 year to realize that I was right. But during that period, I went through a lot of debate. The second was in 2018 to 20. At that point of time, there was only quality stocks used to do well. Neither PSUs nor telecom or metals, nothing used to do well. Every quarter, we used to have trouble because we used to own these stocks and only the quality stocks used to do well. Right. So we went through a lot of trouble at that point of time. So but we held on and it helped us beautifully, but there was enough self-doubt. Not only self-doubt, there was enough criticism.
So what does one do at a time like that? Like with the self-doubt, with the criticism, how do you keep showing up?
There is no choice. Investing is a lonely business. Investing is not arithmetic. These are two things that we have learned over a long period of time. Right. So if you want it to be a business where you're doing everything, what others are doing all the time, you can't make more money. And if you think you'll go right all the time, that is not possible. It's not arithmetic. Right. So that's why the moment you know that investing is a lonely business and not arithmetic, you have to do this business with the problems that it has.
That makes sense. So do you feel like there's a way to distinguish between being early and being wrong?
I wish I knew. In 2018, if I had known that COVID was coming and I should wait for the best ideas that I had, right, and not buy in 2018 and buy in 2020, I would have done it. But I didn't know. There are many, many times you have been early only later. At the time you have bought it, you would think that you're not early. You have bought it at the right time. So that is the biggest challenge of investing, that it is not arithmetic. So you don't know whether you're early. There are times when you're correctly invested, right, and there are times when you have been too early.
Do you feel that there's a way to learn this temperament, or is it something that is built along the way?
This is a debate I've been having. Yeah. What I do in ICICI Prudential is, as far as possible, recruit fresh people. so that I can try to train them in the temperament of investing, so that they understand the temperament of investing.
What is it?
It is like the ability to be lonely and the ability to take pain at some points of time in return for a reward which comes later.
Right.
That is what it is.
Which was that moment for you when you started feeling a little less lonely?
So if you take the year 1999, it was a year where we were lonely because we did not believe in the technology, media, telecom rally at that point of time. It was lonely, completely lonely. Luckily, I was not managing other people's money at that point of time. I don't know what I would have done if I was managing other people's money. But at that point of time, when I was a stockbroker and trying to be lonely, it was very difficult. But the year of happiness was actually 2 years later, in 2001-2. But imagine the year 1999 and being negative on TMT.
Yeah. I feel like over the years, when you've gained all these experiences, what is that one tip that you have for a young investor who wants to just invest in SIPs?
I think one is that, what people do is they pick an asset class which has done very well in the last 5 years and start an SIP. So our view is that if you start an SIP in silver, for example, in January 2026, I think that's a wrong time to start a SIP. You can start an SIP ideally in an asset class which people have not delivered too much return or delivered moderate returns. So if you pick an asset class which has delivered too much of returns, so in 2007, if people had invested in an SIP in infrastructure fund, they would have blamed SIPs. Whereas if they have invested in value funds, they won't have blamed SIPs. So I believe that in starting an SIP in a fund which is done okay, not too bad, but not too good, is very important.
Right. That's the contrarian approach, I feel. Do you feel like this approach helps you at times when the playbooks stop performing, like they just stop, say global conflict or something like that?
Not necessarily, but I would say, frankly, in all these global conflicts, again, you start saying at some point of time they'll end. So you start taking contrarian bets then. So I believe that what works is in the long term, because finally a market price is decided by buyers and sellers. If there are too many buyers, the price goes up. If there are too many sellers, the price goes down. The contrarian benefits out of the fact that there are too many buyers in the stock you're selling, or there are too many sellers in the stock you're buying, and you have done the work. The most important is you have to also do the work. Otherwise, you'll end up buying some junk stocks and then it will go down.
How would you simplify doing the work?
No, as far as investors are concerned, investing in a mutual fund, there's no problem. But if you're doing stock picking and you decide you want to do direct equity investing, you better learn how direct equity investing is. Right. But as far as investing is concerned, it's much easier. If you have invested after a big downturn in the market, you're normally safe. And if you're investing after a very big upturn in the market, you're normally unsafe.
Right, right. So this was pretty much about disagreements. I want to talk about agreements. When people have agreed on an investing idea, what should an investor ask before joining the consensus?
What is the past return? What is the valuation? What are the risks? What are the opportunities? What is the other ideas that one can look at in lieu of this, where there is less competition and there are fewer people agreeing to it?
Right. You say this is not arithmetic, but you have such a clear insight into what is working, and it seems like you have this pattern in your head. Is that how you feel?
No, it is still not arithmetic, because how many mistakes we make in investing on a regular basis, you don't know. Right. So the fact is that if it was arithmetic, you wouldn't be making mistakes. Right. So what you have is actually a process. You don't have arithmetic, but you have a process. So at all points of time, you have to create a process. We tell people create a Word file or a notebook where you define your process of investing and learn from the mistakes and keep revising that Word file or the notebook or what you write in the notebook and keep creating process. A process is like a journal. You create a journal, but that is not arithmetic. You'll still make mistakes, but you'll learn from your past mistakes.
I remember you'd mentioned this in another chat, that writing it down will help you understand what decision you took in the past and why you took it. And that is probably the pattern.
Exactly. The day you write it down, you'll find that you're writing something stupid. The moment talking stupid is much more easier than writing stupid.
That's true. That's true. I feel like a lot of therapists also give this advice that you put this down, you put it down in your journal. Now it applies to the finance world as well.
Absolutely.
So today there is a lot of information. There is AI. People have access. But is there a financial piece of advice that you particularly feel that it sounds smart, but it's actually quite dangerous?
No, I think the belief that equity markets will give 15% per return always, and all you need is either equities, or there is another set of people who believe that all you need is only real estate, or another set of people who believe all you need is fixed deposits only. I think these kind of rules where people decide I will only dabble in only one asset class all the time, I think that is the rule which we don't believe in.
Correct. That's a good tip. I think it really is very insightful. Now, I want to ask you something that's been happening. The rupee is falling and people are considering investing in US stocks. Now, what is your analysis of that logic? Are you aligned with it?
No, definitely not, because it is exactly opposite of what we would call contrarian. If you compare the returns on US stocks in the last 3 years, like NASDAQ, and compare it with what has happened in India, India has underperformed a lot. Rupee has become much cheaper because it has depreciated a lot. So if you use past performance as a framework, it is very tough to now suddenly wake up today and say, I'm going to invest in US. I would argue that if you are invested in US, you can think about taking money out and investing in India rather than the vice versa at this point.
Okay, interesting. That's quite a tip. So I feel like somebody who's young, who's not really understanding the markets, what should their first step look like according to you?
See, I think first they should first save. And there are people I know who used to save, but at the same time they had personal loans and credit card loans, etc. I would say you have to save, and you cannot have both a loan and an investment. Many people I find it's okay to have a mortgage, but otherwise I would say having a costly personal loan and along with that having an investment is something which we worry about. So I believe that saving is first, then it is asset allocation, but saving is first, and ensuring you don't have too much leverage on yourself.
That's a little tough for the younger people. I feel like, no?
No, but I think the moment you start borrowing too much to fund your current needs, I mean, obviously a house is somewhat different, but I would say it is a bit risky. And people have to be careful in what financial decisions they take, not just in the stock market, in their entire lives.
That I agree with entirely, because I feel like the younger people have also started depending on credit cards a lot, and there is this aspirational lifestyle that they're going for. Even if the money is not theirs, they're spending that money. Is there what part of that human behavior do you resonate with, or were you ever like that?
No, actually we all grew up in 80s, and I believe all the people who grew up in 80s can't do that. We were in a world where we didn't have internet, we couldn't even get phone connections. Most people didn't have cars. I mean, no one traveled so much in airlines. So I believe we were in a different world. So for us to become a person who can take a loan and spend it is very, very difficult.
That's true. I feel like if I were to talk about a little bit about your personal life, you had mentioned that you had a 2-person household, and your conversations with your father were around finance. What was it like to then grow up to be the Sankaran Naren?
My father didn't see me as a fund manager. But actually we used to discuss a lot of finance very early in life. We also, at that point of time, I was very fascinated by cricket. So we have discussed cricket and finance the most.
Right. He must be so proud of you. Okay, this is a little psychological, and I feel like that's also your forte. Investment as a study of fear and greed, we had mentioned that temperament is something that people learn along the way. What are some of the tips that you have for someone who's trying to pick on the temperament but is also actively investing?
So I tell people, learn to buy an asset class which is done very badly. So if someone comes and tells you real estate in Bombay has not gone up for 10 years, then you look at buying that asset class. If someone tells you if equity market hasn't gone anywhere for 1 decade, you buy that asset class. And if someone comes and tells you real estate in India has doubled in the last 3 years, or gold has doubled in the last 3 years, stay away from that asset class. So this is the simple temperament I try to tell people to do, which people find difficult to implement. Correct. Actually. Correct. Because there is something called FOMO. There is a fear of missing out. So people find it very difficult. They hear me, but they don't implement it.
It might seem risky as well, but like I would listen to you. If you were to tell me this is what I'm supposed to do, I would just do it. So yeah, I get it. I get the risk that people might feel, because in general, we do have this herd mentality. I'm not sure if you agree that applies to the financing decisions as well.
Absolutely. Everyone follows herd mentality. That is why it is very important if you can do the opposite of the herd mentality in investing in assets. Right. Because the herd mentality shows that there are more number of buyers or sellers. Correct. So anything like today, waking up today and saying, I'm going to remit money to buy stocks in US at 95, 96 rupees is herd mentality.
Yeah. Now this is something that, again, you had mentioned. As someone who often gets it right, where does humility then stay? Like how is one, if somebody is doing well in the markets, how do you bring in humility? Because I know that is something that you feel.
It is tough, but I tell people a contrarian style itself brings in humility. And I always say my special child has always brought me humility.
That's really, really nice. Thank you so much for sharing that. Now, better strategy, investing more when markets fall or staying consistent with SIPs?
No, I think it depends on your temperament. If you are the kind of person who if an asset class does very badly, suddenly one day wakes up and says, let me sell it, then it's okay, just continue with your old SIP. Right. But if you are the person who's gone to the next level, I would say you have to buy more when it falls. Good. It depends on what level of temperament you have reached. And you should have some ability, like particularly if you're doing stocks, doesn't apply. Right. So because people apply it to stocks, it works much better in asset classes than stocks.
Correct. That makes sense.
No, I think give importance to money. At the same time, you can't make money in the markets overnight. If somebody thinks that it's like a career. A career takes 30, 40 years. Like that, making money in the markets also takes decades. So I think people think that you can make money very fast. Actually, the people who decide that they will approach it as a long-term way of making money are the people who have actually made money. And then the people who say, I want to make money in the next 2 years in markets, that's not going to happen.
Yeah, that sounds very Bollywoodish, no? Like that, I'm just going to enter and like get rich. But that's not how it works. I feel like that's one thing that's been common in all these conversations that I've had, that think long term. That's also something that young investors struggle with, because it's an instant gratification world that they're often living in. Like you mentioned, in the 80s, internet was not there, but we have it, we get the likes, we go to the gym, we want the abs in like 6 weeks, not even months. So I feel like that's a struggle. Is there, again, a tip from you to navigate that?
That's what I think Warren Buffett calls it. You take money from the impatient to the patient. Investing takes money from the impatient to the patient. So that is why, you'll have to be long term. There is no choice here.
There is no choice.
So if you decide you want to make money in the next few years, it is not going to happen. Then it is only then in big crashes you will be able to buy for the long term.
That makes sense. Noted. Now, if every retail investor could follow only one rule and forget everything else, do you have a rule?
Simple, asset allocation. And asset allocation means that you are invested in all asset classes, and if possible, invest in the asset class which has done the worst.
That's a good one. That's a good one. Now, one thing you'd want a 25-year-old who's watching this to remember, and maybe that needs to stay relevant for the next 10 years. No pressure.
Again, asset allocation.
Okay.
But the challenge is, remember, asset allocation means investing in the asset class which is done badly. So it can't be that in Jan 2026, you wake up and say, I did not have gold in my asset class, now let me put gold in the asset class. That is not asset allocation, that is anti-asset allocation. Asset allocation involves investing in asset classes which is also done badly. So you can't wake up in Jan 2026 and say, I want to put money in silver. That is not asset allocation.
Yeah. In general, we've seen like during this conflict that gold has not performed the way it's usually anticipated to. So a lot of people have struggled, and so this makes a lot of sense. Yeah. So anything else that...
Nothing else that I know. The biggest learning that we have is the investment rules are easy. To follow them is tougher. Whether it is writing a journal on your decisions, learning from your mistakes. So it is actually, the theory is easier, practice is very tough, much tougher than what people think.
Yeah, but keep at it.
Yeah, keep at it, and the theory is not the difficult part, theory is the easy part. Practice is the tougher part.
Right, right. Now you have 3 decades of experience in the markets. After these many years, do you still feel the urge to check the markets on a red day, or is it something that now you've kind of become calm about?
Only check the markets on a red day. Every day in the evening we check the market, what has happened to NASDAQ. In the morning we check whether there are any tweets. So we check the market all the time. How we react is different. We use the red days to buy. Right. So that is how it looks. But are we continuously watching the markets? It's very difficult that you get up in the morning and you are in an environment where you can see what has happened to NASDAQ the previous day. You will see it.
Is that your social media, like a relevant one?
Yeah? It is my social media, not Instagram or Facebook.
Yeah, that's the instant gratification that you're getting.
Yeah, but I don't act on it, but we see it.
Correct, correct. That makes a lot of sense. Thank you so much. This was such a wonderful, crisp chat that I've had, and your insights are absolutely wonderful. I've made a bunch of notes, and I'm so glad to have you on Paytm Money Masterclass.
Thank you. My pleasure also on Paytm.
Thank you.
Thank you.
That was Mr. Sankaran Naren sharing his wonderful insights on Paytm Money Masterclass. Let us know in the comments below who you'd like to watch next.
Mutual fund investments are subject to market risks. Please read all scheme-related documents carefully before investing.